morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is May 27th. Let's dive into the week's stock market news. European stocks dip amid uncertainty about rate cuts. UK inflation slows less than expected. European stocks retreated from recent highs as doubts arose about the timing and magnitude of potential interest rate cuts by central banks. The Pan-European Stocks Europe 600 index closed 0.45% lower, while major indices like Italy's FTSE MIB and France's CAC 40 also fell. In the UK, inflation cooled less than anticipated in April, reaching 2.3%, the lowest level in nearly 3 years. However, this figure missed both the consensus and the Bank of England's projection of 2.1%, potentially dampening hopes of a mid-year rate cut. Core inflation, excluding volatile items, also surprised on the upside at 3.9%. Financial markets now seem to be pricing in only 1/4 point rate cut this year instead of 2. Meanwhile, the Eurozone showed signs of economic resilience. The Composite Purchasing Managers Index, PMI, for May reached a 12-month high of 52.3, indicating an expansion in business activity. While services activity remained robust, manufacturing PMI, although improving, still contracted for the 14th consecutive month. Additionally, negotiated wages in the Eurozone rose 4.7% year-over-year in the first quarter, partly due to one-off payments. Despite these mixed signals, ECB President Christine Lagarde expressed confidence in the possibility of a rate cut in June, contingent on data supporting the central bank's inflation outlook. Now our insight into alternative markets. The rising tide of liquidity in private markets. A new era of flexibility. The winds of change are blowing through the private markets, bringing with them a renewed focus on liquidity. Limited partners are increasingly seeking faster access to their investments, while private equity firms are seeking ways to manage capital calls and buy time for portfolio companies to reach their full potential. This shift in demand is driving the emergence of innovative liquidity solutions that promise to reshape the private market landscape and usher in a new era of flexibility. The drivers of the liquidity shift. Several factors are contributing to the growing demand for liquidity in private markets. Increased allocation to private markets. Institutional investors and high-net-worth individuals are allocating more capital to private markets, drawn by the potential for higher returns compared to public markets. This increased allocation has led to a greater need for liquidity to manage portfolio risk and meet capital obligations. Maturing private market funds. As private equity funds mature, limited partners are seeking distributions to realize their gains and redeploy capital. This demand for distributions is putting pressure on fund managers to find liquidity solutions. Market volatility. Recent market volatility has highlighted the importance of liquidity in private markets. Limited partners want the ability to access their investments quickly during times of market stress. Emerging liquidity solutions. The private market industry is responding to the demand for liquidity with a range of innovative solutions. Secondary markets. Secondary markets, where limited partners can sell their stakes in private funds to other investors, are becoming more active and sophisticated. This provides a valuable avenue for limited partners to access liquidity before the end of a fund's life cycle. Subscription line financing. Subscription line financing allows private equity firms to delay capital calls from limited partners, providing more time for portfolio companies to mature and generate returns. This can be particularly beneficial for firms investing in longer-term assets, such as infrastructure or real estate. Structured liquidity solutions. These solutions, such as preferred equity or structured debt, offer a way for investors to access liquidity while maintaining exposure to the underlying private market assets. Current value and future feasibility. The value of these liquidity solutions is already evident. Secondary markets have seen record transaction volumes in recent years, while subscription line financing and structured liquidity solutions are gaining traction among investors and fund managers. The longer-term feasibility of building more flexible fund structures depends on several factors, including regulatory developments, investor preferences, and the continued evolution of the private markets. However, the current trend suggests that liquidity will become an increasingly important consideration for both investors and fund managers. A new era of flexibility. The rise of liquidity in private markets is not a temporary phenomenon. It is a fundamental shift that is reshaping the industry and creating new opportunities for investors and fund managers alike. By embracing these new solutions, the private markets can become more accessible, flexible, and responsive to the needs of all stakeholders.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.